Welcome to the deep dive. Today, we're jumping right into some pretty compelling warnings coming out of Europe.
Yeah, from some key figures, the Dutch finance minister, their central bank president, and Ursula von der Leyen from the European Commission.
Exactly. They're all signaling these, well, significant shifts in the global financial and economic picture.
And the big question we're digging into for you is, where is this heading? Are we talking recession, maybe something worse like a crisis, or even a depression?
And crucially, what does it all mean for the global money system, particularly the U.S. dollar's role as the reserve currency? That seems to be a major theme.
Definitely. So to get a handle on this, we've been looking at an analysis that really dives deep into these warnings, the economic signs, and importantly, the alternatives.
Alternatives to the dollar, you mean?
Yeah, things like the euro, maybe the Chinese yuan, SDRs, those IMF things, special drawing rights gold, obviously CBDCs, even Bitcoin gets a mention.
Okay, so our mission here is to cut through all that complexity and give you the key takeaways. What's the real risk of a downturn? What's driving it? How might the money system change? And, what could it mean for investments?
Right, and hopefully do it in a way that doesn't just overwhelm you with data.
Let's try. Okay, first up, the Dutch Minister of Finance. He predicted an unavoidable clap. I think that means hit or blow to the economy. Pretty stark language.
It is. And what's interesting is his focus. He's really zeroed in on preventing national debt from rising.
Why is that specifically?
His argument is that high debt forces future tax hikes, and he believes those high taxes kill economic growth because people have less money to spend. It's a very supply-side view.
Makes sense. And he connects this potential hit to bigger global stuff, doesn't he?
Yeah, he talks about a global turning point, mentions security, the U.S. stance on Europe, the trade war that's still simmering, and just major shifts in how the world economy works.
And he thinks America gets hit hardest first.
That's his prediction, yeah. But with knock-on effects for Europe, naturally.
Okay, but here's where it gets a bit contradictory, maybe. Despite saying no high debt, keep taxes stable, the government's plan is to not fully adjust income tax for inflation.
Exactly. This is a really key point. They're talking fiscal prudence, but this move effectively acts as a hidden tax increase.
How does that work again?
Well, inflation's running at, 4.1%? But they're not lifting the tax bracket thresholds by that much. So even small pay rises push more of your income into a higher tax band.
Ah, okay. So even if you get a raise, more of it gets taxed away than you'd expect.
Precisely. And it's expected to bring in about 1.3 billion euros, mostly hitting people in that second income bracket. It's a subtle way to raise revenue.
My economists are noticing.
Oh, yeah. They're pointing it out, calling it kind of deceptive, especially given the rhetoric about avoiding tax increases.
Seems like governments everywhere are wrestling with these inflation issues. Which brings us neatly to that whole stagflation worry. Inflation's up, but growth is sluggish.
Yeah, Dutch inflation at 4.1%, up from 3.7% just the month before. And this is happening even though the European Central Bank's interest rate policy is supposedly neutral. It shouldn't really be fueling inflation on its own.
And meanwhile, growth forecasts, particularly for big economies like Germany, are hovering near zero.
That's the toxic mix. You potentially get a recession defined as, 2 straight quarters of the economy shrinking combined with rising prices. That's stagflation.
And that makes things incredibly difficult for central banks, right?
Absolutely. The standard tools clash. If you cut rates to boost growth, you risk making inflation worse. If you raise rates to fight inflation, you risk crushing growth even more. It's a real bind.
And that hidden tax we talked about feels even worse in that context.
Definitely. Let's use that example. Say inflation is 3%. Your salary goes from 40,000 to 41,200 euros. Looks like you kept pace. Right. But if the tax bracket threshold only goes up by, say, 1.5%, more of that 41,200 gets taxed at a higher rate than your 40,000 did.
So your actual take-home pay, your purchasing power, hasn't really kept up, even though the headline salary number did. And you're paying more tax.
You got it. It's a sneaky erosion of real income.
Okay, let's shift gears a bit. This feels even bigger picture. The potential decline of the U.S. dollar's dominance. The Dutch central bank president, Klaas Knot, actually suggested the euro could potentially fill that gap.
Yes, and that is a significant statement. Coming from a major European central banker, openly talking about an alternative to the dollar is, it's noteworthy.
It really is. The dollar's been the bedrock for decades. Global trade, oil pricing, commodities, international loans, so much is priced in dollars.
And not points to specific signs. He mentions lower demand for U.S. Treasury bonds, which forces interest rates on them higher. That can signal waning confidence.
And at the same time,
At the same time, demand for gold is rising. Gold is often seen as that ultimate safe haven when confidence in currencies or government debt falters.
it fits with those theories like Ray Dalio's about changing world orders and the cycles of reserve currencies, doesn't it?
It certainly resonates with that cyclical view of history, yeah. Knott also made a practical point for Europe.
Which was?
He suggested that if more international trade was invoiced in euros, Europeans would be less exposed to dollar fluctuations, those exchange rate shocks. He pointed out that dollars lost like 9% of its purchasing power just since the start of the year.
Wow, 9% is substantial.
It is. And he argued a stronger international role for the euro could also benefit Europe by attracting more foreign investment.
Which would mean?
Lower borrowing costs for European governments and companies. If more people want to hold euro assets, the interest rates on those assets can be lower.
So reading between the lines, Knott isn't just observing. He's perhaps subtly suggesting Europe should actively push for a stronger euro, maybe even through things like Eurobonds.
That seems to be the implication. Common debt issuance, like Eurobonds, would create a large, liquid euro-denominated asset similar to U.S. Treasuries, which could boost the euro's appeal significantly. It's still controversial, though.
Okay, this ties into the even wider view from Ursula von der Leyen, the president of the European Commission. She had that really stark quote, "The West as we know it no longer exists."
Powerful words. She didn't stop there, either. She suggested we're moving from a world order to a world disorder.
And what did she blame for that shift?
Several things. The U.S. losing its dominant position, the big power struggle between the U.S. and China, and Russian aggression creating, as she put it, a political vacuum. It's a picture of a much less stable, less predictable world.
So her solution is for the EU to step up.
Essentially, yes. She advocated for the EU to become more geopolitically active to try and help shape whatever new order emerges, or at least manage the disorder.
It really feels like these different threads, the economic warnings, the currency questions, the geopolitical shifts, are all interconnected.
They absolutely are. And when you look at these potential big shifts, especially in the reserve currency, history offers some cautionary tales.
Like the British pound.
Exactly. Economists draw parallels to the period between the world wars when the British pound sterling lost its top spot, but there wasn't an immediate clear successor.
And that period was not great economically.
Yeah.
The Great Depression happened then.
Precisely. The analysis we looked at emphasizes that these transitions of reserve currency status are rarely smooth sailing. They often involve significant instability and economic pain.
And there's a worry now that no single currency is really ready to just take over from the dollar if it were to falter significantly.
That's a major concern. Take the euro. It's the currency of a huge economic bloc, but it still faces big hurdles.
Such as?
While there's still no full political union behind it, there isn't that single, massive, easily traded government bond market like U.S. Treasuries, Eurobonds would help, but they aren't really here yet. Capital markets are still fragmented across different countries.
Plus, different national rules, different taxes.
Right. And the European Central Bank historically has maybe been a bit more cautious or slower to react in crises compared to the Fed. Also, the euro isn't used that much globally outside the eurozone itself.
And wouldn't a super strong euro actually hurt European exporters, like Germany?
That's the other side of a coin, yes. A much stronger euro makes German cars or French luxury goods more expensive for buyers outside the eurozone, which could dampen exports.
So the euro as the sole replacement seems unlikely right now. What about that idea of a basket of currencies?
Yeah, the idea comes up maybe a mix of the dollar, euro, yen, pound, maybe the yuan. But think about the practicalities for businesses.
Sounds complicated.
Extremely. You'd have huge transaction costs swapping between them, incredibly complex bookkeeping, constant hedging against fluctuations between all those currencies. How do you even manage inflation and stability for a whole basket? It seems unwieldy.
Yeah, maybe more trouble than it's worth.
Yeah.
Okay, let's pivot to something more tangible, maybe gold and silver. They often act as barometers. There was that mention of Trump's line.
He who owns the gold makes the rules.
Yeah, mentioned in the context of Canada having basically no gold reserves while China is trading gold at record levels.
It does highlight gold's enduring role, doesn't it, as a store of value, especially when governments or currencies seem shaky.
Absolutely. And we're seeing money flow into gold ETFs, exchange-traded funds. That suggests it's not just central banks or China buying. More regular investors are getting interested too.
And the price hit a record $3,500 an ounce. That seems high.
It did hit that peak recently, and such a rapid rise does make people nervous. Is it just speculation, or is it signaling something deeper, like that loss of confidence in treasuries or the dollar we talked about, or just general geopolitical fear?
It's interesting that gold has actually beaten the NASDAQ stock index over the last 5 years.
That is interesting, and maybe even more telling. The ratio of the gold price to the S&P 500 index is apparently back at levels similar to 2008.
Oof, 2008. Not exactly a comforting comparison. No. It suggests investors might be fundamentally reevaluating risk and value between traditional financial assets and hard assets like gold. Another striking one, the Dow Jones Index relative to gold.
How does that look?
Apparently, the Dow to gold ratio is lower now than it was back in 1929.
Lower than 1929. Wow. Now, that excludes dividends on stocks, but still, right? It suggests gold has held its value incredibly well against stocks over the very long term.
It does paint a compelling long-term picture for gold as a value store. Now, shifting slightly, what about silver? The gold-to-silver ratio was mentioned?
Yeah, it went above 100.
Right. Which is rare historically. And usually when it gets that high, silver tends to catch up later, often outperforming gold for a period.
So potentially an opportunity for people looking at precious metals, maybe contrarian play?
It's something analysts point to, yes. The analysis suggested gold might be in a short-term pullback after its big run-up, but the long-term trend still looks positive. Silver might have more catching up to do based on that ratio.
And you mentioned something fascinating earlier, analysts starting to price things not just in dollars.
Yeah, increasingly seeing analysis that prices stocks or gold or even Bitcoin in terms of other assets like ounces of gold or silver rather than just dollars. It's like people are searching for a more stable measuring stick than fiat currency.
That really speaks volumes about the underlying confidence or lack thereof in traditional currency measures.
It certainly seems to reflect that anxiety. And these worries aren't just among European officials or gold bugs. Bank of America also put out warnings about a changing economy.
What are they seeing?
Declining U.S. consumer confidence quite sharply, apparently, and fewer job openings hitting a 4-year low, signs the U.S. economy might be cooling off.
And didn't the Dow Jones have a really bad April?
Yeah, tracked for its worst April since, believe it or not, 1932, right in the Great Depression.
Goodness. So, economy cooling, bad month for stocks. Does that mean the Fed will cut interest rates soon?
Well, that's the debate. Despite those signs, the Bank of America CEO apparently doesn't expect the Fed to cut rates anytime soon. He's still worried about inflation sticking around.
Which clashes with what some politicians like Trump are calling for.
Exactly. You have Trump pushing for rate cuts. Then you have the French finance minister warning Trump not to destabilize the U.S. economy with his ideas. And the ECB warning his pro-crypto stance could unsettle Europe. It's getting quite tangled.
It really is. And speaking of crypto, there was that interesting snippet about the Swiss National Bank.
Yeah, indirectly investing in Bitcoin by buying shares in MicroStrategy, a company famous for holding a lot of Bitcoin on its balance sheet.
That's pretty significant for a major conservative central bank like the SNB, even if it's indirect.
It suggests that even very traditional institutions are at least looking at Bitcoin, perhaps considering it as some kind of potential asset, even if just through equities.
And how's Bitcoin itself behaving in all this?
Its price seems to be acting differently, maybe decoupling a bit from the stock market. Sometimes it acts like a risk-on bet, sometimes more like a safe haven. It's kind of finding its place.
And people try to predict its price using cycles and mining costs.
They do. There are models based on past cycles, the halving events, the cost for miners to produce new Bitcoin. It's crucial to remember those models aren't guarantees. The crypto market is still very volatile.
Okay, so pulling all these threads together, it feels like the main takeaway is significant uncertainty.
I think that's fair. You have clear warnings about a potential recession, maybe worse. You have serious questions being raised about the future of the global monetary system and the dollar's role.
The euro is being discussed as an alternative, but it has its own issues. Other ideas like currency baskets seem complicated.
Right. And meanwhile, you see these movements in precious metals, gold hitting records, the gold-silver ratio, flashing signals, analysts pricing things differently. It suggests a real unease with traditional financial assets and currencies.
It feels like a lot of moving parts, a lot of potential shifts happening at once.
It really does. Which brings us to a final thought, maybe something for you, the listener, to chew on.
Go ahead.
Given everything we've discussed, the historical parallels when reserve currencies change, this growing trend of valuing things outside the dollar, how should you perhaps reconsider your own understanding of value? And what role might different kinds of assets play in a world that seems to be, well, changing quite rapidly?
And are there other indicators, maybe things we haven't focused on today, that might give more clues about where things are heading?
Exactly. What overlooked signals might be out there? Definitely some food for thought as we navigate these uncertain times.